Before I get into my weekly spiel, I'd like to take a second to encourage you all to sign up for our upcoming U.S. market webinar. That'll be taking place this upcoming Thursday at 7 p.m. Singapore, Hong Kong time. If you're in the U.S., that's 7 in the morning. The reason I'm so excited about this upcoming webinar is we have a super guest for this month. It's Dan Ives of Wedbush Securities. Of course, Dan is one of the most famous tech analysts on Wall Street. You see him on CNBC all the time. Normally on these webinars, I do quite a bit of talking myself. I'm going to leave that to a minimum, so you'll have plenty of time to hear Dan's Ives on the really big tech stocks that are driving the U.S. stock market. And we'll also leave a lot of time at the end for question and answer. So if you sign on to our webinar, you'll have an opportunity to ask Dan Ives about your favorite U.S. tech stocks. If you're watching this video right now, please forward it to your friends. Please hit the like button, etc. So that way we can get a big audience for Dan, because that'll help us to get other famous guests going forward if we get a big group to listen to Dan speak on Thursday. Now, going back to me talking about the market, last week I spoke on Wednesday and I suggested that the U.S. market, which had been on a strong upswing, I think it was at an all-time high on Wednesday, would probably go into a pause mode. And sure enough, since last Wednesday, the S&P 500 has been nearly exactly flat. Why did I think it was going to pause? Well, I said two things that have been driving U.S. stocks higher were kind of run their course for now. The first one, quite obviously, was earnings reporting. We're already mostly done, or even almost very close to being completely finished with S&P 500 companies reporting their earnings. And second quarter earnings were much better than expected. At the beginning of June, FactSet, kind of looking at what the average U.S. equity analyst predicted for each one of those S&P 500 companies, was saying that earnings growth for the second quarter was going to be about 4.5%. As it was, after all these companies reported earnings that were much better than what the analysts expected, quarter-on-quarter earnings growth for the S&P 500 for the second quarter was closer to 12%. So that's quite a bit better than expected. And during that backdrop that we've had for the last 45 days of companies just reporting better earnings than what the analysts expected, that really helps U.S. stocks go higher. The other thing that had been helping the U.S. market is, of course, expectations of rate cuts, because the bulls on Wall Street really love lower interest rates. And when I was speaking last week, expectations for a rate cut from the Fed in September were over 90%, a near certainty. And of course, that's a good thing for markets, except once it's above 90%, they really can't go much higher. As it was after I spoke on Wednesday, we had the PPI index number, the producer price index inflation number, which measures wholesale inflation or factory gate inflation. That showed a much higher rate of inflation than what economists expected. And some of those expectations of rate cuts cooled. So now we're closer to 80% expectations for a rate cut in September. And I think last week we were expecting 3 rate cuts before the year ended. Now I think market expectations are only for 2 rate cuts before 2025 ends, although they'll probably, the market expectations are for another rate cut in January. So it's not all that different. But like I said, we had all those things going for the market. It wasn't going to get any better than that. That's why we're in a pause. So what do I see going forward? I don't see much of a change. I think we're going to remain in the pause for the near term until another catalyst emerges. So that's what I said last week. If you think about what I said 2 weeks ago, When I said that there were two things about the market that I found surprising. The first thing I talked about was the Treasury yields, or the 10-year Treasury yield. I thought at over 4.2%, 10-year Treasuries yields looked a little bit high, because I thought although that there was going to be an increase inflation caused by the tariffs, that increase in inflation was going to be temporary only. And in fact, once the tariffs had raised prices, that would do something to deaden demand for products and actually become a little bit disinflationary, and you would see prices dropping. So against that view, I thought a 4.25 or whatever on the 10-year yield struck me as a little bit too high. As it was, we did have that factory gate inflation number, and the 10-year yield is about 4.3%, but I'm still sticking to my guns that inflation's coming down. I'd just like to add one more anecdotal piece of information about that, is I was looking at the chart of the number of counties in the United States that are experiencing declines in real estate prices, nominal price declines in real estate prices. And that number is going up and up. It's still not a majority of the United States, but it's getting pretty close to half of all counties in the US are experiencing price declines on a nominal basis. And if you look at inflation, it's very rare to have an inflation problem while real estate prices are declining. So just another reason I think inflation's going to come under control. Another reason I think Treasury yields are going to drop. The other thing that I said that was surprising is that I said, although crude oil prices were already on the low side, since that the world was now producing more crude than it was consuming, and since those surpluses of crude didn't seem to go out as far as the eye could see, I thought that crude oil prices were going to drop in order to get that supply and demand back into balance. As it is, the downward trend in oil prices has continued. And if you're thinking about my argument about inflation going down, well, that's just another reason why inflation will go down if we have lower energy prices. Of course, all that would also be benefited if progress continues in negotiations between Ukraine and Russia in order to have a peace deal. Of course, Trump had his meeting with Putin last week. Not much came out of the meeting, but obviously a little bit of momentum is created. And so maybe we will have a peace conference between the two sides, and maybe they'll be able to get a peace deal. That would certainly be bearish for commodity prices. That will be disinflationary. And I think last week I suggested that ending the war in Ukraine would be a positive for European equity markets. Okay, so that concludes what I was trying to say about where I expect markets to go forward. I'd like to, okay. Now, just to kind of end things up, I'd like to end by looking at what's on the horizon. Fixed income traders are going to be looking very closely at events in Jackson Hole, Wyoming, where the Federal Reserve is having its annual symposium on central banking. On Friday, Fed Chair Jay Powell is going to be giving a speech. I don't expect any big surprises from the speech. He'll be continuing to say that the Fed is taking a wait and see, look at the data before it commits to doing rate cuts or very many rate cuts. I think what people will have their ears attuned to are any comments about the U.S. labor market. Of course, there were these big revisions in monthly job growth numbers, which sort of leads you to believe that the U.S. labor market isn't quite as strong as people had believed. And we'll have to see how Jay Powell comments on those figures while he's talking, because obviously if the labor market is weakening, that would really encourage the Fed to speed up on cutting interest rates. And of course, as I said before, the bulls on Wall Street love lower interest rates, so you could see the stock market moving higher on the basis of that. I also have been saying that we're almost done with the earnings reporting season, but we have a few big box retailers reporting in the US. We have Walmart, we have Costco, we have Target. When those companies report, people will be a little less interested in what they said about the second quarter, their bottom line, their gross sales. What the analysts are going to be asking, they're saying, well, we already see the tariffs coming into play. In July, the U.S. federal government collected $29 billion in tariff revenues. That's not a small amount. And so they'll be asking, okay, is that having any effect on prices? Are you charging more for things? Are you paying more for things because of the tariffs? And as they're doing that, do you have any comment on how consumers are reacting to it? So there'll be a lot of interest in that from those three companies. Obviously, best case scenario will be if the companies say, yeah, sure, we're paying a little bit more for things because of the tariffs, but it's not so great, and consumers continuing to buy, all that would be very positive for the market. I'm not exactly sure that's what they're going to say. I think all those companies are going to be very reluctant to say anything overly bad about prices being higher, because when they do that, it tends to make Donald Trump angry, and nobody wants to be on Donald Trump's naughty list going into the holiday season. So anyhow, we have some big earnings reporting from U.S. retailers at the end of the week. We have Jay Powell speaking about Fed policy on Friday. And of course, on Thursday evening, we have our U.S. market webinar with superstar tech analyst Dan Ives as our very special guest. Thank you.